All right. Perfect. All right, ladies and gentlemen, welcome back to Commercial Real Estate Investor Club. Excited to be sharing some great information to bring value to you. And Susanna, how are you?
I'm good. How are you, Joe?
Doing
I'm
amazing as
excited.
usual. Yeah, I'm excited too. I'm excited too. You got a lot of slides to share today for our audience, our students. So let's go ahead and jump right in. And again, guys, we're looking to add incredible value to you, whether you are looking to at a potential project acquisition yourself, or you need financing, or any or all of the above. We're here to help and gladly serve. So this is part of our community. So I'm going to go ahead and share my screen, get this show on the road. So I'll help navigate through the slides. Susanna, you just tell me next slide or next, and I'll just go ahead and move them. So Susanna, the floor is yours today.
All right. Well, thank you, Joe. So I really wanted to put together just an overall, just a starting point that gives everybody like a baseline to start off with. And then as we continue, then we can get into all of these bullet points. But anybody who is interested or needs to, right? Some people really need to learn commercial financing. This is a really good starting point and will just be done in 20 minutes. So everybody loves real estate partly because you can leverage it, right? And you leverage that by providing debt financing. So capital is scarce, financing allocates it efficiently. Leverage accelerates growth beyond retained capital. So if you were to buy any piece of real estate and not put debt on it, you would likely be in the single digit return, which is might still be a great thing. But once you put debt on it, you're leveraging it and you likely are your likelihood of getting to double digits is a lot better. So real estate generates stable cash flows and it's ideal for structured debt. Let's go to the next one. So commercial financing can be debt or equity, but most of the time when people talk about commercial financing, they're referring to debt. And it's used to fund income producing real estate collateralized by property, and it's underwritten. This is important, first of all, by NOI, which is the net operating income, and secondly, by loan to value and DSCR. The NOI and DSCR are very connected. So let's go to the next slide. So when you're buying any type of real estate, what are your choices? Where are you going to obtain your loan? So traditional banks obviously are everybody's kind of that's the most well-known option. CMBS, these are securitized loans. They typically offer interest-only options, but these are like Wall Street securitized loans and they're available through debt funds. Bridge loans are mostly for properties that aren't stabilized yet, also available for almost every property type. And mezzanine debt, and this is what a lot of people sometimes confuse with private equity, but mezzanine debt is actually debt in second position, sometimes also collateralized with either in second position, sometimes also collateralized with the entity, with the LLC. And then private equity slash institutional capital. So let's say you're buying a $10 million building and you need 70 million loan, right? So you're going to get that loan, let's say, from either number one or number two, bank, CMBS, or number three, bridge loans. So, but let's say you don't have the other 3 million, then your other options are to go look for mezzanine debt or private equity. And that's not going to get you all the way to the 10 million, but it's going to help bridge the gap between the 7 and the 10. Let's go next. So what are the key metrics that lenders use? So everybody knows LTV from residential financing. So these are loan to value, right? Loan divided by property value. And while we use that metrics in commercial financing, we actually look at DSCR, which is your NOI. So DSCR is debt service coverage ratio, but basically it's a measure of how much above your monthly payments is the property going to cash flow, and that needs to be a positive number and at a minimum typically of 20% higher than your debt. But the calculation is net operating income divided by your payments. Then cap rate, as we all know, is very, very common in commercial real estate. Also determines the value, also determines where your debt needs to be. So just a quick and dirty, your debt your loan interest rate should be lower than your cap rate. If your cap rate is 6%, then try to get debt below 6. But cap rate stands for capitalization rate, and it's the net operating income, which means net income divided by purchase price. And then lastly, loan constant. This is a lot of lenders use this, which is your payments, your annual debt service divided by the loan amount. So those are the metrics that lenders use. And we can go through all of them because like at least 2 or 3 of them should be very, very familiar to anybody who is either investing or who is interested in originating commercial loans or referring commercial loans. And I promised our viewers, because we are live on TikTok right now, and I think some other platforms as well, that we would also next time talk about how somebody can use this knowledge to start generating income. So we will definitely go through that, but you need to have this overview. So property types, there's all kinds of flavors of commercial real estate. We're just going to go through the 4 or 5 main ones. So the one that everybody is familiar with is multifamily, meaning apartments, right? So apartments, student housing, they have high occupancy, is somewhat recession resilient just because everybody needs a place to live. And the common financing there, almost every lender provides financing for multifamily, but the one that kind of everybody wants and the dominant player in that market is agency debt, meaning Fannie and Freddie are very active in that market and provide very competitive loans. Let's go to the next one. All right, property type 2, office. Everybody also familiar? Offices vary by class. And so right off the bat, it needs to be classified, whether it's class A, B, or C, and location. The risk from remote work, as we have seen, can cause vacancy, and it's a lot more susceptible to fluctuations in the economy. How do we underwrite office? So lease rollover is something that a lot of people don't take into account. So we're still going to go through the same calculation. But the net operating income, right, divided by your monthly payments needs to be 20 or 30% higher than your payments. But we get clients all the time, Joe, as you know, they're buying an office or retail property and they go, okay, this is my NOI. But the other important thing is what is the lease rollover? So if a client wants a 5-year fixed rate, but the leases are expiring in a year or 2 or 3, that is not going to be available. So that's very important, and you have to time your refinancing to your lease rollovers. Then tenant credit is very important, especially if it's a corporation, it's publicly traded, you know, that's easy and everybody kind of has a comfort with it. But what if it's a mom and pop restaurant or a salon or an industrial, like well, this is an office, but what if it's like a law firm? You need to still have very good confidence that that tenant is going to be able to pay that rent because it's your only source of repayment. So don't forget those 2 things in office. Okay, let's go to the next one. We're talking about how to do commercial financing for everyone on TikTok. I see you guys are commenting. We're providing this free training, and we're just going over the different commercial property types and how to finance them. So third property type is retail commercial. These are strip malls, power centers, neighborhood retail centers, and you see them everywhere. So if you have an anchor tenant, we call it an anchor tenant, but it's basically a big box store, typically a grocery store or a department store, that is attracting the tenants to that power center or to that retail center. Without an anchor tenant, I would say you're kind of downgrading some of the financing options that you have, but still perfectly doable. We actually have a couple of kind of famous people in the Arizona area that specialize in this, and this is all they do, and they're very successful at it. So here, lenders will evaluate tenant mix and lease terms as well. Again, so you need to have strong tenants, you need to have a good tenant mix, and then the lease term. I can't get you a fixed rate financing if your lease is a month to month, right? Okay, let's move on, Joe. What other property types do we have? This is one of my favorites, industrial commercial property. It's basically warehouses, logistics centers, your car mechanics, any kind of manufacturing. That's what we will classify under industrial. It's driven by e-commerce and supply chain needs, has stable cash flows, and it's very attractive to lenders. One of the reasons why it is attractive to lenders is if you have a commercial property and you're leasing it to an industrial tenant, that tenant is unlikely to leave because that's their livelihood. So it's not like having a tenant in multifamily where somebody might, get another job offer and they have to move, before their lease is up. So if somebody is paying your rent and they run their business out of it, they're unlikely going to leave. Let's go to the next one. And this is some people's favorite, hospitality, hotels, resorts, and extended stay. So there are people who really, really love this space, but it is cyclical and it's performance based. So where it's somewhat similar to multifamily, but the difference is once somebody signs a lease, they're going to be paying that month after month. In a hospitality type environment, that is not the case. And that leads to revenue-based underwriting. So that underwriting looks completely different than your multifamily. Let's go to the next one. All right, so let's talk about structuring. So again, for my example before, $10 million asset, let's just say you need a 70% loan to value, $7 million loan. And these are just examples that I just took. These could be any numbers, but this particular one at 600,000 net operating income if we can get debt service at 420,000 a year, would be at a 1.43 DCR. Then the reason why I wanted to show this here is because you have to be within the guidelines of loan to value, right? Which is typically 75% or less. We're at 70, so that's a go. And the DCR, depending on whether you're multifamily or office or whatever, sometimes there's different debt service coverage ratio requirements, but 1.43, you should be good with either one of them. You go to the next one. Thank you. Okay, what are the risk factors in commercial financing? So market risk, Joe, you and I have lived through this a few times. Anybody who's been in real estate can attest that things kind of fluctuate with the market, right? When things are good, they're really good, and you better have the reserves and the right loan to weather the fluctuations. So there's also asset-specific risk, meaning an office building is going to be more viewed as a more risky asset than, for example, multifamily. And then there's also obsolescence that we have to take into account. What is new construction today in 20, 30, 50 years is not going to be Class A. Then the borrower risk, and this is so important when we get requests for financing. And Joe, you've seen this before. A lot of people get into real estate, but they don't realize that the track record, the liquidity, and the experience on the borrower side is very important. So if anyone is looking to get approved for a commercial loan and we're helping you get through that process, we're going to talk to you about your track record, your experience, and your liquidity. Having said that, if you don't have what is necessary from the borrower standpoint, assuming everything on the deal is checking out, we can help guide you on how to bridge that. And then, of course, there's regulatory and environmental issues. I know in California, they come up with new laws as far as, environmental guidelines are concerned, and that can lead to problems. And regulatory also, right? So all the banks are federally regulated, so we have to pay attention to that. Capital stack explained. So how do we acquire a commercial property? So there's your senior debt, which is basically just your bank loan. This is the lowest risk, and they're first in line. They have the first claim. They're also the lowest rate. This is your cheapest money. So when you are looking to acquire, if you want to do it, you should always start with your cheapest cost of capital, which is senior debt. Mezzanine debt is much higher, usually double digits that you can have behind the first. Preferred equity are companies that basically want to invest in commercial assets and are looking for people who are experienced in that space and can provide them a return that is higher than what the banks get. Now, they also don't get the same assurances like the bank, right? The bank is in first position. Preferred equity is not, doesn't have a claim to the asset. It only has a claim to the entity that is purchasing the property. And then common equity is just money that you and I are going to put in as part of the down payment. Let's go to the next one, Joe. All right, the loan life cycle. So once we decide we want to purchase this particular property, we're going to apply for the loan. So that's step one, which is origination. Once you submit the application, it goes through underwriting, appraisal, and all the way through to approval. Once you get the approval, then you close on the deal, you own the building, you put your capital stack in place, and now you're the successful owner of a commercial piece of real estate. Servicing, so again, very different from residential financing. Once you buy a house and you obtain a residential mortgage, you never hear from that lender again, right? They might send you a statement about, here's your taxes, your insurance. Yes, we paid this and we paid that. But with commercial, you do actually have to provide ongoing reports, typically once a year, as to the performance of your property, because you're going to have those covenants in there. Your building must continue to cash flow. If it doesn't, there's provisions in your loan documents as to what will happen after that. And then everybody is doing this for a reason, and that's to make money. So your exit is very important. You need to know kind of going into it. You can have multiple exit strategies, but it's either refinance when it matures, or you're going to sell, cash yourself and your investors out. Okay, let's go to the next one. This is just a quick case study. Multifamily deal in Austin, let's say 200 units. Not sure you can buy 200 units for 20 million right now. I'm just using this for very, very easy numbers. $20 million value, let's say $14 million loan. So remember, on multifamily, agency is always going to be our first choice if we can get it, because those have the best rates. And even though those rates are not at 4.5, they're probably high fives right now, or low sixes, depending on the deal. Your net operating income must be 1.2 or higher. So in this particular case, it was 1.2 million, and the debt at 4.5% gave us a ratio of 1.43. So we're in the green. And the IRR to equity, this is an important calculation for anybody who's looking to have investors in their group. And that is a calculation of how profitable is your commercial deal. And this is over the years, over the length of the time that you're going to own it. And just to give you an example, if you had a building that generated, let's say, 10% return on a yearly basis, but when you sell it, you're selling it for 50% more than when you bought it, which is, maybe let's say 3-4 years down the road. So your return is not just the 10%, but it's also the big bump that you get when you sell it, but you basically calculate that big bump over the length of the time that you've owned it. And just so everybody knows, the IRR is typically in the low 2 digits. Thank you, Joe, so much for doing this for me. Okay, let's go to the next one.
Oops, sorry.
What lenders want? What do lenders want? Everybody wants money to buy real estate, but what do lenders want? Lenders want a strong sponsor with track record, number one. If you are not a sponsor with a track record, doesn't mean you can't buy commercial real estate, but then you really need to dig into some of the other tips and tricks of maybe syndications or partnerships. They want a solid business plan and projections, because they have to have comfort that you're going to be able to comfortably pay back their loan so that they can make their profit and you can make your profit. So if there are any questions or if something seems weak, we usually address that during the application process, so that by the time the lender sees it, this needs to be solid. Conservative leverage profile, this is my personal favorite. I work with a lot of syndication groups, and they always want the maximum leverage. I understand why, because that actually directly affects your bottom line and the return you are providing to your investors. However, When we talked about the market risk going up and down, you have exposure with that. We can have rents go up by, 5% every year until one day they don't. Or like in the Arizona area or all of Southwest was going up by 10% a year until they didn't. So if you're constantly pushing your leverage to the brink, and a lot of people do it, no shade here, just my personal strategy is to leave a little bit of leeway. And then lastly, your clear exit or repayment strategy. So commercial financing, as we know, have maturity. So there's no such thing as a 30-year fixed 30-year amortized loan. So let's say you get a 30-year amortized loan, but has a maturity in 10 years. How are you going to handle that 10 years from now? What is that maturity? Are you going to refinance or do you plan to sell prior to that 10-year balloon? Next one, Joe. What do borrowers need to know? So again, my favorite, don't over leverage, optimize for yield and stability. The longer you can stay in the deal, the more profitable you're going to be. Time forgives so many mistakes. So if you can just hang in there, you'll probably be okay because real estate in general has performed very well. But if you're over leveraged or if there's just no room, just every little bump might basically kind of throw you out of the game. Also, understand prepayment penalties. That's also very different from residential real estate. If you are in an environment where you believe rates are going to go down, understand that your prepayment penalties may prevent you from being able to refinance into a lower rate. But the prepayment penalty, there's different kinds. There's a step down prepayment penalty and there's very complicated calculations. So just make sure you understand that going into the deal and make sure it aligns with your exit strategy. Keep liquidity for interest reserves. And the bankers and underwriters are going to make sure that that is the case. But you have to have money in the bank ready to go for not just reserves, but for any kind of contingencies. And build lender relationships over time. Everybody talks about lender relationships, and it's not so much that is the lender going to be loyal to? It has nothing to do with loyalty. It just means that if your deal qualifies for the lender to loan on it and they already know you, they're going to have a better comfort level in providing you with that loan. And then I saved some time for Q&A. So, Joe, I hope I covered a lot. I think, people are going to have questions, but I did say to a few people that if they're unable to attend, we'll send it out to them after the fact.
Yeah, I mean that's the beauty behind our community, our club, guys, because if you really were looking at all those definitions, there's so much to unpack there. We have these one day full events where we go even deeper. I mean, we're talking 30 minutes, Susanna. You did an amazing job throughout all these different terminologies, what have you. And I can assure you there's somebody out in the audience that were what is a DSCR? What's an IRR? What's this? What's that? And folks, that those are the terms you got to really get familiar with because that's how you do great calculations and stay out of trouble. Teaming up with one of us in the Commercial Real Estate Investor Club, whether it's both of us, Susanna or myself, or somebody that you meet through the Commercial Real Estate Investor Club is critical because I am a firm believer always will be commercial real estate investing as a team sport. There's a lot to unpack there. There was one slide that Susanna pointed out about like, okay, you might have the money. Do you have the resume? Have you ever done multifamily? Are you coming from single family trying to buy a 50 unit and you've never done it? Well, that's like an automatic disqualifier unless you have somebody that has that kind of resume and track record. Right, Susanna?
Absolutely. I just don't, the way you say it is just always so much more interesting than, coming from you. So no, you're right. You have the money, but do you have the resume? That's well put.
Yeah, we're peanut butter and jelly, Susanna. Yeah, she has a way of delivering, so do I, and that's why we team up as well, because I know I might speak to one audience and the way she communicates will resonate much better. And again, teamwork makes a dream work. I'm also a firm believer. One of our philosophies here at Commercial Real Estate investor club is alone, you're going to go fast, but together you are going to go far. We want to go far with you. We want to take it the distance. I mean, this went by really quick, Susanna. We're right at the 30-minute mark. I mean, this is why folks keep joining, share with your friends. I see a bunch of people on TikTok as well. That's amazing. I don't even recognize these names, so it's super, super amazing to have them here, Susanna.
Yeah, I promise the folks on TikTok, because we keep posting and we keep posting faceless content, but we're very serious at providing you guys with the not just the basics, but basics or intermediate, but enough to start making money in commercial real estate, whether that's through ownership or if you're an agent, you want to get into that, or just be able to provide referrals. Our company pays for referrals, and every other company out there that does commercial loans pays for referrals. It does take some know-how, just the basic of, does this deal have legs? And then other people are going to run with it and close it for you and then just pay you a referral fee. And a lot of people actually want to become commercial loan officers. So Joe and I can speak to that, and we're happy to provide you with as much information as you need to not only help you be successful, but we also are looking to add people to our team if somebody wants to get into it. So we're hoping to share here. And I hope that you guys will ask questions, DM me, interact on TikTok or through CREIC on school, which is where we were actually just live on. I'm not sure if I mentioned that earlier.
Perfect, perfect. Well, yeah, there's so much to unpack here. So keep showing up, subscribe to our YouTube channel, join the school community, reach out to us. If you have any questions at all, that's a great platform to go ahead and reach out to us directly. Send us a message on school and we'll be glad to help you out. Susanna, that was so awesome. Anything else you wanted to
Oh,
share or
no, I
anything?
appreciate your help so much. I do have to get the technology down for next time. No, I just want to, we have actually a few people now join on TikTok. So we are here teaching commercial financing every Tuesday at noon. So please join us live. And if you guys have questions, we'll get you where you need to go and we'll provide you with ways to monetize that. So thank you for joining. So I'm going to turn off the TikTok page, Joe. If I can figure that out. There we go.
Beautiful.
Okay.
So, ladies and gentlemen, again, I super appreciate your participation, the questions. That makes us bigger, better, and stronger as well. So, together, everyone gets to level up, including us. So, we want to keep bringing our A game each and every single week. And yeah, anything you'd like to ask or a topic you want to talk about, feel free to send it in the message on school or reach out to us somehow via social media on Facebook, YouTube, Instagram, wherever we are. We'd love to hear from you. Take care, Susanna. Amazing job. Love it, love it, love it.
Thank you, Joe. We'll see you next week.
All right. Have a great day, guys. Talk to you later. Bye.
Bye.